analyses that suggest that a low of significance could be complete. It doesn't mean that the bear market is over, but it does mean that bulls could see a little bit of reprieve here, and that bears could be on the defensive for a little bit. So let me go ahead and share my screen here, and we can start looking at the S&P 500. I'm going to want to look at some bond markets too, some interest rate, sovereign debt yields, and then look at some currencies as well, because again, I think that what's going on in the currency market right now is really a good sign for stocks. So the biggest news when it comes to the S&P 500 is that we took out this high from earlier in October. Now, last week we talked about the very key level of resistance in the $3,900 level, and where are we right now? We are testing that key zone right now. So we talked about also how a potential false breakdown from an inverted saucer pattern could lead to a quick, sharp rally. As the saying goes, from false moves come fast moves, and that is unfolding accordingly. So this is the moment of truth. We'll probably know by this week or next whether this rally is for real or not, but the fact that we made a higher high compared to the high from earlier in October is a very good sign. Let's also talk about the seasonality with respect to October. It's notorious for seeing crashes, but also completions of important lows. So not out of the woods yet, but if we start to clear this resistance zone, I think it's a really good sign. So let's talk about the whole point of today's discussion, which was the Bank of Japan intervening in the currency market. So here you see the intervention that happened on Friday. The usdjpy dollar yen currency pair rallied to a new multi-decade high on Friday. Bank of Japan had to step in to sell dollars, buy yen, and this led to a pretty sharp reversal that engulfed basically almost the entire week's worth of trading range. So a little bit of a rebound yesterday, but since this is not reflective of today's price action, let's go ahead and look at the ETF real quick, FXY, and we'll see that yen is catching a little bit of a bid today. So what we're seeing now is the dollar sell off, and it's not just in the yen. We're seeing this in the euro as well. So we can take a look at the euro ETF here. Euro, getting a pretty strong bid. So what is happening? Basically, the US dollar is selling off finally, and this also comes after the Federal Reserve and members of the Fed last week indicated that we're not far from slowing the pace of rate hikes, and that is the initial rumblings of a pivot. So if we're going to see other central banks around the world maintain a slow but steady rate hike trajectory, but domestically we're going to slow the pace of our rate hikes, well, you could see how that could be a catalyst to shift capital back away from the US dollar and into those foreign markets. Now, here is the key, is that a lot of times stock market rallies or lows are complete when the dollar tops out. We actually saw that at the COVID lows of 2020. And I'll go ahead and pull up a chart of the US dollar to show what I'm talking about. You'll see when we zoom out, as I like to say, when in doubt, zoom out. I didn't come up with that phrase, but it is a good one nonetheless. That in March of 2020, the dollar made a high and commenced a correction for about 10 months. Now, we did have an upside objective in the US dollar in the 120 area, but there does seem to be pretty widespread consensus at this point that the dollar is going higher. So we're actually starting to shift that outlook, and at the very least, look for a period of prolonged consolidation. I still think the trajectory of the US dollar is higher. However, it does look like we could be due for a period of sideways price action, which could be enough to send stock markets back higher. And it's so unique about this rate hiking period is not only has this been the most aggressive monetary tightening cycle the Federal Reserve has employed in decades. Really, you have to go back to the 70s to see anything along those lines. But a lot of times when we start a rate hike cycle, you see stock markets continue to rally for a period of time. It takes usually, 6 to 18 months, sometimes even as long as 2 years before things start to crack. That didn't happen this time around. Basically, as soon as the Fed ended QE and began raising short-term interest rates back in January of this year, the market rolled over. That was the high, the equity market, that is. And so what if now we enter a period whereby we at least pause in the rate hikes, and then that's enough for stocks to regain their bearings and start another rally. Well, the rally arguably has already started, but I think we will see a lot of help from bonds. And I think we have to be wary of a potential yield curve inversion because short-term interest rates, what the Fed controls, doesn't look like they're going to be coming down anytime soon. Even if they pause, they're going to keep them even. But I think the risk here is that we see a more pronounced yield curve inversion, especially when we look at the yield curve Treasury bill and the 10-year Treasury bill. I do believe that we saw, actually, let's double check that real quick just so we know for sure. I do believe that we saw the first signs of a yield curve inversion. Let's see. We did have our first yield curve inversion between the 3-month Treasury bill and the 10-year Treasury note. And we haven't had within the yield curve since we began the tightening cycle. Now, there's been a lot of talk about the 2-year Treasury bill inverting against the 10-year note. That's all fine and dandy. But, now that we're seeing a little bit of a bid come in here for bonds, that is interest rates coming down a little bit, don't be surprised if the economy does start to slow a little bit. But then the trillion-dollar question again is how do commodities fit into this picture? Well, I think right now crude oil is catching a pretty good bid, and we've talked about the possibility of seeing multiple pivots from the Federal Reserve over the next 6 to 18 months. Kind of if they take the foot off the brakes here in the next few months and kind of slow the pace of rate hikes, that could be a catalyst for commodity markets to reignite their bullish momentum. Because you wouldn't know this by looking at the CPI numbers, but a lot of these commodity markets like crude oil, grain markets, etc., have experienced 30% plus drawdowns from their highs, and normally that can bring some deflationary implications into the bond market, but it hasn't really manifested as such. But now that we have a potential short-term high in the 10-year Treasury yield, that means that bonds could rally, and that means that liquidity is starting to creep back into the market, which is a good sign for stocks. So my argument is that the market looks 6 months ahead, but it likes to discount future events. And there are plenty of historical references and examples of stocks rising in rising rate environments. And since we did not see that period at the beginning of the rising rate environment where stocks rallied, it was a situation again where we stopped QE, started raising rates, and stocks basically crashed 30%. That's a historical anomaly. So if we pause here, at least for a few months, it looks like they're going to raise rates another 75 basis points in the 2nd of November. But after that, the pace of rate hikes is slowing down. And, at the very least, we might even see some easing by the end of next year. So it depends what the longer term interest rates do. We can take a look at the 30-year interest rate on the 30-year Treasury, and you can see that we're not far from creating a bearish island reversal here. If the 30-year yield closes below 4.21, we have an island reversal right here, and that could lead to a prolonged correction or consolidation. We've been rising really nicely within this ascending channel, and so when these channels break, it doesn't mean that the bull trend is nullified. Rather, it means that the rate of ascent is no longer in effect. So, I think that the intervention that we saw from the Bank of Japan last week really served to give dollar bears some impetus. And I think this could be a high that holds for a little bit here, especially when we zoom out and look at what happened in the Japanese yen. And I want to talk about Japan too, because, the two most liquid bond markets in the world right now are still actually Japan and the United States. The German Bund's having some issues. The UK gilt's having some issues. Obviously, the Bank of England had to step in. We've already seen some interventions from central banks, pivots of the sort. You had the Bank of England basically doing a mini episode of QE. You had the Bank of Japan intervening in their currency markets. So we're already seeing those dovish pivots, if you will, by central banks. And I would have to go back. We can look here. Why not? We have to really go back, look and see, where we are on a relative basis against the Japanese yen and the US dollar. We reached the highest level since basically 1990 during this latest rally. So, I think there's a lot of support in the dollar yen, basically in the 138, 140. If we corrected down to that level, I think the longer term trend is still up at this point, but that will give stocks some time to basically recover, in my view. So let's actually look at the Japanese Nikkei too, because you read a lot about this in economic history textbooks, but it's pretty amazing when you look at a real bubble. And I think a lot of the crypto people should study this too. The Japanese Nikkei hasn't recovered from its peak in '89, so it's been a pretty much there's been tradable opportunities, obviously, but imagine if you were buying Japanese stocks back in 1990. You've made nothing in 32 years. So this is where risk management comes in. At what point are you ready and willing to admit that you're wrong? And we incorporate that into our strategies each and every single day when we are analyzing, whether it's stocks, bonds, cryptocurrencies, commodities, or whatever. So pretty much all I wanted to talk about today. Stocks are still looking pretty good in my view. So I think that this rally has some legs for now, assuming we clear 38, 3,900. If we don't, then we're just going to form another lower high. Keep in mind, the trend is still down from a purely technical standpoint. Even though we took out this high from earlier in October, we've yet to see a higher low. So I wouldn't get too excited, but we are seeing some pretty notable leadership from energy and healthcare and stuff like that. So that's where you should focus and look at the stuff that's displaying relative strength. What stocks and sectors are at or near their multi-year highs. We can even look at, XLE. It's at multi-year highs. Healthcare was lagging a little bit last week, but that's looking a lot better now. So I think healthcare, and that's really important for the Nasdaq too. I still think that tech, like communications and tech, have some issues in this macroeconomic environment. But I think healthcare as a sector within the Nasdaq has a lot of potential to become a leader and help propel that index higher, which is so very important to see that widespread participation within the indices. So that's all the time I had for today. Hope you enjoyed the stream. You can find my work at www.mmacycles.com. We published an ETF report last week. We analyzed 8 ETFs of various sectors in the market. You can also find it at benzinga.com. Go ahead and check that out. We do cryptocurrency analysis as well as breakout stock picks, which, by the way, a lot of those breakout picks are working very nicely now. So thanks for watching, and we'll be back at you